gold backing a system is to have the prices much higher than they are right now. So 3,000 to me is low to where it will ultimately be. I think that's quite realistic. And at $3,000 gold, where do you have silver? If you realize that silver and gold have had a 42 to 1 average price relationship for the last 100 years, even though it's coming out of the ground at 7 to 1, 3,000 divided by 42 is $71. If you took 3,000 divided by 7, $428. Is that crazy? I don't know. You tell me. That's what it's coming out of the ground at. Even at 2350 divided by 7, you end up with 335. So I think metals will go higher than people think possible. It is because it is distorted by a handful of commercial banks that have these massive concentrated short positions.
Gold's range and silver's trend both remain in place and may offer reliable setups for the third quarter. Friday's close marks the end of the second quarter, and the precious metal has notched a new all-time record quarterly closing price for the third consecutive quarter. The yellow metal is ending the week around $2,336 an ounce, up more than 5% from the end of the first quarter. With over 25 years in the financial services industry, Andy Schectman is a leading expert specializing in precious metals. From Andy Schectman's viewpoint, central banks acknowledge gold as genuine money. He anticipates that precious metals prices will surpass current expectations due to distortions caused by banks. Based on his observation, Schectman states that while a strong dollar typically pressures gold prices downward, central banks' ongoing gold accumulation suggests prioritizing its stability over other assets, despite positive real yields being disregarded due to perceived higher inflation. This year, amidst the US dollar's 5% rise against major currencies, gold has still managed an 11% increase. Despite the theory that higher rates should deter gold investment, Schectman mentions that gold has outperformed most assets since 2000. He predicts this trend will continue as central banks accumulate gold, ignoring conventional economic relationships. Central banks have been gobbling up gold, and based on responses to the World Gold Council's 2024 Central Bank Gold Reserve Survey, their appetites for the yellow metal aren't going to be satisfied anytime soon. While shifting his perspective, Schectman highlights the stark contrast between soaring stock indices driven by large firms and the Russell 2000, which paints a bleaker picture of broader economic struggles amid mounting concerns over escalating national debt. Now we present the clips of Andy Schectman's insights from his recent interview with Capital Cosm. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
These relationships of interest rates or a strong dollar mean nothing to the central banks. The central banks don't care about any of that. They just want the gold. And so, the theory is if you have much higher interest rates, there is an opportunity cost for holding something that doesn't yield any interest. People don't realize that gold's appreciated by 9.9% per year since 2000. It's outpaced everything, maybe with the exception of Bitcoin. It's accelerating now because the central banks are accumulating it and they don't care. You see, it's the positive real yield and the strong dollar, and gold's still moving up. That's very, very bullish. I think that's these relationships mean nothing to the central banks. And I think that's really the most important thing to keep in mind is that you have flows of metal at record levels leaving the exchanges, repatriation. We talked about India, who bought 1.5 times the amount of gold all of last year. They bought it in the first 4 months of this year, and they repatriated 100 metric tons from the Bank of India. They now, in essence, hold all of their gold. From the Bank of England. The Bank of England is by proxy the LBMA. And then just a couple of weeks ago, we talked, probably when I was on your show last, we saw Nigeria, South Africa, Ghana, Senegal, Cameroon, Algeria, Egypt, and Saudi Arabia bring all of their gold back from the COMEX or from the New York Fed, which is in essence the COMEX. And you're seeing these central banks, they don't care about a positive real yield. Let's just call it what it is. This positive real yield is fugazi. I mean, yeah, so, that's if we believe inflation's 3.5% and you're getting 5% in a short-term treasury. But we know that the inflation numbers are a lie. We know that inflation is much higher than that. But even still, if we take it at face value, when you have a positive real return in short-term treasuries, it should be the death knell for gold. And a very strong dollar, where it should be the inverse of gold, And I think that's incredibly bullish. How much these central banks want to accumulate gold, they're the ones I think that are keeping the price elevated as they continue to accumulate it, because the unit, as we know, is 40% gold, which is the only other tier one asset in the world. So the central banks know the playbook. And that's what I would take away from it, is that this positive yield on the 10-year treasury or on the short-term treasuries was so enticing. Then why are all of these countries selling treasuries and buying gold? And I think that's really what I would take away, is that in the end, they just want the gold and they don't care about any of these other relationships. Massive debt. But I mean, to me, the debt is kind of the sideshow. Yeah, the debt, it would be a reason for people. At some point, the debt has to matter, right? And interest rates that have been suppressed forever, that have created distortions in asset prices, all these things have to matter. We once had a very thriving economy. I think it's been brought to its knees by things like political corruption, manipulation of the news, inflation, the printing of money that gives the illusion of a thriving economy when you see just a handful of stocks pushing the whole indice up. And you realize that the Russell 2000, as an example, which is a much broader indication of the economy, most of it's underwater. If you spent $100 every second of every day, it would take you almost 2,000 years to equal just the 6.2 trillion we've spent in the last 12 months. This is the kind of, I don't know, excess spending, and you mix into it the meddling in affairs of other nations that I think accelerate the decline of the dollar. You're seeing countries like China unload $53 billion in treasuries a month ago. You're seeing what's happening all around this country, politically, socially, morally, all of these things, they all have significance.
Regarding central banks, Schectman explains that they are reducing their dollar holdings and accumulating gold, now their second largest asset. As per Schectman, the U.S.'s growing debt and the risk of treasury inflation make treasuries less attractive, further eroding the dollar's reserve status. China and Hong Kong whittled their combined holdings from over $1.4 trillion in 2012 to 2017 to $992 billion. During the capital flight panic in 2016, China's holdings of treasury securities fell sharply as it tried to prop up the RMB. It increased its holdings again, but never all the way back to the prior level, and holdings have declined from then on. Furthermore, Schectman predicts that gradual de-dollarization will lead to a sudden shift. Significant actions by countries like Saudi Arabia, such as turning down the G7 invitation, joining Project Enbridge, and not renewing their petro deal, indicate an accelerating de-dollarization process. The shift will rapidly intensify once most countries move away from the dollar. Let's get back to the interview.
I call it logarithmic decay, little by little by little, then all at once. And you're right, it's not going to happen overnight until it does happen overnight. And the thing that most people are missing is, what's happening in terms of, if you look right now, gold as an example, just became the second largest holding in central bank stashes, replacing the euro for the first time ever. And that's the little by little. You can see that the amount of dollars held in the central bank's coffers has fallen. It still represents, I don't know, 60+%, but it was at 75%, a decade ago. It is moving in that direction. It's one of these deals where I think it's happening in a manner that you can see it's really beginning to gain steam and momentum. But it doesn't suit these countries at all to flip the switch until they're ready, until they have built this massive infrastructure. If you had 59 countries all in the BRICS and a common settlement currency, the unit, which we've been told, and trade is moving, and their military coordination is there, and all of the trade and sea routes are there, and they'll flip the switch. This is something that I think is being done very methodically. So yes, it won't happen all at once, but it is happening. And you can see it is indeed happening. I mean, ask yourself this question: who the hell wants to hold our treasuries? Who wants to hold treasuries that, can be confiscated, can be inflated away, can be defaulted upon, in a country that's creating $1 trillion in debt every 100 days, Danny, and almost 200 trillion in debt. 150 of it is unfunded. Medicare, Medicaid, Social Security, government, military pensions. We have a spending addiction that's out of control, a government that has chosen to weaponize the treasury market. So in every way, I think it is indeed happening, and you're seeing all of these countries strike deals in local currencies and not in the dollar. So all of these deals, 80 billion done on the sidelines at this last Russian meeting, or now Saudi Arabia now selling oil in other currencies, or Saudi Arabia buying corn and soybeans from Brazil, paying for it in digital yuan, or Russia and India doing deals in rupee and ruble. All of these deals are chipping away at the settlement status of the dollar. And the fact that these countries are selling treasuries and buying commodities to replace it chips away at the reserve status of the dollar. So little by little by little by little by little, then bang, all at once. I don't know when that all at once is, but we're closer to it than we've ever been. And when you see Saudi Arabia turn down an invitation to the G7 meeting, and then send their finance minister to the meeting in Russia, when you see Saudi Arabia become a full-fledged member of Project Enbridge, which is the vehicle to sidestep SWIFT, when you see them not re-up their petro deal, we're getting closer than we've ever been. That is the de-dollarization process. And it's one of these deals where it has to be done the right way. You can't move too fast, or you cut off your nose to spite your face in every way. So it's happening. Don't know when it is, but allows people to be naysayers and dismiss it because nothing's happening. Yet if you pay close attention over the last 3 or 4 years, the amount of developments have been extraordinary, and they are increasing in magnitude and in speed. So our media doesn't do a bad job. They do no job of telling people what's happening. So when that all at once happens, when there's a realization collectively by the majority of the countries around the world that the dollar is no longer a preferred vehicle for reserves, the Treasury especially, but for settlement even, that there are other alternatives. And you go from a slow drip of detreasurization and de-dollarization into a faster and faster and faster and faster, and then a boom.
Analysts foresee a necessity for substantial increases in gold prices, potentially reaching $3,000. Based on historical ratios, they envision silver climbing above $71 or possibly higher, considering mining dynamics. How will the ongoing global shift from the US dollar influence your investment strategies regarding precious metals in the coming years? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.